Today, we're talking about a portfolio so simple, you can buy it and hold it forever. Most investors don't fail because the market is hard. They fail because their portfolios are too complicated. Too many ETFs, too many accounts, and too many strategies. It's confusing and stressful. Hi, I'm Dr. Z. I'm a university professor and a long-term investor. I started this channel to share what I know, what I have learned, and what I'm still learning, so you can make better financial decisions. Now, that's why a 3 ETF portfolio works so well. One for the broad market, one for growth, and one for diversification. It fits every stage of life. The percentages change as you get older, but the strategy itself, that never changes. This isn't a trend or hype play. It's a forever portfolio built to grow over decades, even in 2026 with high interest rates, AI and tech growth, and global market shifts. By the end of this video, you will see how keeping it simple can outperform complexity. Now, let's check out Jack Bogle's classic 3-fund portfolio. It's very good, but there are a few things we need to update for today's markets. Bogle's 3-fund portfolio has been a cornerstone for long-term investors for decades. The philosophy is simple. Own a broad market fund, a bond fund, and an international fund. That combination gives investors steady growth, diversification, and a peace of mind. And for many years, it worked exceptionally well. But here is the catch. Some of the assumptions behind that approach don't hold as strongly in 2026. Interest rates are higher for longer. Growth sections like AI and semiconductors dominate. Younger investors are skeptical about bonds. The principles are timeless, but the implementation needs a small modern update to fit today's market realities. Now, speaking of bonds, that brings us to the next question. Why bonds don't work the same way they used to, and what that means for your portfolio today. For decades, bonds were the go-to safety net. Steady returns, low risk, and a way to protect your portfolio when stocks dropped. A classic example is BND, a broad bond ETF. But over the past 5 years, BND actually dropped about 14%. Well, a broad US stock ETF like VOO increased around 85%. That's a huge difference. Bonds aren't balancing equity risk the way they used to. Even during market crashes, bonds haven't always been safe. In 2022, VOO dropped about 18%, but BND also fell roughly 13%. Meanwhile, traditional hedges like gold only dropped about 0.4%, and silver actually increased around 2.6%. So, yes, bonds still have a role in smoothing risk, but today, they are no longer the automatic stabilizer they once were. All right, let's break down the 3 ETFs that make up my 2026 portfolio and why each plays a unique role. First, ETF number 1 is a broad market core. This is the foundation. When you invest here, you're not betting on a single sector. You're buying a slice of the entire US economy. Hundreds, sometimes thousands of companies across industries are included. This is your long-term compounding engine. Instead of trying to pick winners, you are riding the overall growth of the economy. Historically, US stocks have returned about 9 to 10% per year, even through recessions. rate hikes, and market crashes. Looking ahead to 2026, micro tailwinds like innovation, productivity gains, and steady population growth suggest the long-term trend remains intact. Some examples include VTI, VOO, or SCHB. They are low-cost, diversified, and tax-efficient. This part of your portfolio is steady, boring, and critical. It keeps you invested when volatility hits. Next, ETF number 2, growth/thematic, AI, tech, and semiconductors. This is where you take intentional risk to boost the returns. AI isn't a short-term trend, it's a multi-year transformation in business, data, and profits. And it runs on semiconductors. Every AI model, data center, and automation system depends on chips. Examples include SMH for semiconductors, AIQ for broader AI exposure, or QQQM to capture large, innovative tech companies. These are satellite positions designed to enhance returns, not replace your core. They are volatile, yes, but computing power demand is rising faster than supply, creating growth opportunities for patient investors. This isn't trading, it's a conviction-based long-term investing. Finally, ETF number 3 is diversification or hedge. Global exposure, precious metals, or both. It's not flashy, but it's strategic. Markets don't go up forever. And after long periods of strong equity performance, volatility returns. For global diversification, examples include VT, VXUS, or IXUS. For precious metals, think GLDM, IAU, or SLV. Gold tends to preserve value, and silver can benefit from monetary and industrial demand, with a slightly higher volatility. Together, these 3 ETFs create a rule-based forever portfolio, a stable core, a growth accelerator, and a diversification layer to manage risk. That's why this structure works across all ages, risk tolerances, and market conditions, even in 2026. Now, let's talk about people retiring now or planning to retire early. This is where the strategy shifts from pure growth to stability and risk management. One of the biggest risks is sequence of returns risk. Big losses early in retirement can permanently damage your nest egg. So we balance growth with capital preservation. Now, here is the approach with the 3 ETF portfolio. ETF number 1, broad market core, still drives growth, but the allocation is smaller than someone 20 or 30 years from retirement. ETF number 2, growth thematic, is a modest slice. Exposure to AI, tech, and semiconductors, but without risking your retirement. Diversification or hedge takes a larger role. Global ETFs, gold, or silver help reduce volatility and protect capital. The goal isn't to maximize your returns this year. It is to preserve your nest egg while letting it grow over time. Even in 2026, with higher rates and market volatility, this approach keeps you invested, avoid panic selling, and smooth your retirement journey. Now, investors about 10 years from retirement, ages 50 to 60, you are still accumulating, but with some guardrails. Growth still matters, don't abandon equities. ETF number 1, broad market core, drives the bulk. But diversification ETF starts to play a bigger role to reduce volatility. Don't get over-conservative too early. Pulling back too much now can hurt long-term outcomes. Staying invested through cycles is critical. 10 years out, allocations should reflect potential upside and protection against downturns. Now, ages 30 to 45, roughly 20 plus years from retirement, peak earning years, decades of compounding ahead, and the chance to take full advantage of growth. Portfolio should be heavily weighted towards growth. ETF number 1, broad market core, provides the foundation. And ETF number 2, growth and thematic, can be larger to capture AI, tech, and semiconductor tailwinds. Ignore short-term noise. Markets wobble. Sectors rotate. But that's not a signal to panic or make tactical shifts. Treat your portfolio as a long-term machine. Discipline now often determines retirement success. Now, how to start your first year? The most important principle: start simple, don't wait for perfection. You don't need to time the market or optimize every percentage. What matters is actually starting. Dollar cost averaging works great. Invest a fixed amount regularly. Let market fluctuations work for you. It reduces stress. Avoid bad timing and build discipline. Avoid common beginner mistakes: overtrading, chasing hot sectors, or abandoning your core during volatility. The first year sets the tone for decades. Remember, the best portfolio is the one you actually start and stick with. 3 ETFs, consistent contributions, patience, that's your recipe for long-term success. Well, that wraps up our 2026 3 ETF portfolio guide. If you found this helpful, make sure to like, comment, and subscribe. And share which ETF you're starting with in the comments below. Your long-term investing journey starts today. Let's together make better financial decisions.